Welcome back, everybody. Tommy O'Brien with Tom O'Brien. Markets have turned negative in the last 15 minutes. We got the Dow down 56 points, trading 24,950. S&P's negative by 2 points, trading 2763. And the NASDAQ negative by 2 points as well, trading at 7508. So, Tom, it's Wednesday. We got a little EIA action on Wednesdays, 10:30 a.m. Eastern Time. We get the EIA inventory report on crude oil. Let's jump over to the NADEX platform and take a look at this market. So currently, we have the April contract up, trading at $60.82. And let's just see what type of trade possibilities we have here. We have 11 minutes exactly until those numbers come out. And I'm going to jump in here first and take a look at maybe the 9 a.m. We're in commodity spreads, crude oil, 11 a.m. spreads.
9 to 11, yep.
Okay. So these expire at 11 o'clock. These would be the shorter time frame that you would be trading if you were looking maybe to trade a spread with the 10:30 oil report just coming out in about 10 minutes. So right now, again, oil trading $60.83. So we have price points here, and if we're looking for a volatility trade, as we do sometimes, maybe getting both sides of the market, as in buying a spread with bullish potential, selling a spread with bearish potential, we have price points that would line up either with $60.50, so about 30 cents from there, as oil is kind of dropping as we speak, just around $60.80, or would have one at $61.25. So on each side, you're going to have about 30 to 40 cents of intrinsic value, depending on which spread you're using, right? You know, you could use the $60.50 spread, and then in that case, just to pull it up, you would have bullish intrinsic value, as in if you'd be buying the spread with $60.50, you would have 40 cents of intrinsic value. I'm sorry, yeah, 32 cents. Right now it's trading $60.82. The floor of that's $60.50. You'd be buying it for 40 cents. And 32 of that would be intrinsic value. So that gets a little expensive when you're paying so much for intrinsic value if you're just looking for a pure volatility play in either direction. And of course, you could do the same thing where then you would be shorting the $60.50 spread at the same time. This one, of course, out of the money, just premium, and that would be the $8. So you'd be looking at about $48 with a lot of value to the bullish side here. Now, to flip that around, if you wanted a similar trade with intrinsic value to the bearish side, you could set up the same trade using $61.25 as your point with $1.50 in each direction. So here's your $61.25 up to $62.75. This one being, Tom, the one that's just completely out of the money this time, right? Because you're at $60.80, call it. You got 45 cents to go up. So that would be the one that you'd have all just premium. And you can see, because it's so far out of the money, it's only $6 in premium. But then you would be selling the one that goes $61.25 down $1.50. And that is going to be the one that's going to have about 45 cents in intrinsic value now. And you can see that that lines up for about $49. And this would be one that is a volatility trade. You have both sides of the market. Anywhere away from $61.25 on both sides, you start to gain value. This one being all intrinsic value to the bearish side. So those are the 11 a.m.s. They get a little bit expensive, but if you have a bullish or a bearish bias, those might be a nice trade to set up. And again, you could just take one side of that trade, right? If you're bullish, if you're bearish, you could just take the one spread. We kind of like to set up the volatility trade, which is nice, looking for some action at the 10:30 oil report. So those
which we've had lately.
Oh, we have. The last 2 weeks at least, and my memory is short, but we've gotten spikes in one direction, maybe 50 cents a dollar, followed by a reversal of $1 to $2 in one case.
That was a monster 2 weeks ago. Yeah.
And oil in general has had some serious volatility, man. It has. Right. Okay, so those are the 11s. And let's just jump in and see how the 12 o'clocks line up. Now, these get set when they open. So, for instance, the 9 to 11s are getting set prior to 9 o'clock, depending on where oil is trading at 9. The 10 till noons are getting set just prior till 10. So they're going to have some different spreads occasionally. Now, the 10s till noons are a little bit different in that you could have $60, which wasn't an option.
Okay.
And so that is going to be 20 cents away from where we are. So if you had the bullish one going from $60 to $61.50, again, this one's going to be completely out of the money, no intrinsic value. And then your bearish spread going from $60 down to $58.50 would be the one that has Am I seeing that? I'm sorry. No, we're at 61. Thank you. So these do line up actually $60.75. Okay.
Right.
So that's not bad. That would be 4 pennies away from where we're currently trading.
Sure,
so again,
which is pretty cool.
It is.
General.
So to start it over, here's 60.75 up $1.50 to 62.25.
Yeah.
We're within 5 pennies of where this contract begins. So the bullish spread is going to have 5 pennies of intrinsic value. You'd be buying that, $29. $5 of that is actual intrinsic value. And on the bearish side, you'd have no intrinsic value, just premium, and you can see the difference in the cost of the two is basically the intrinsic value, which is on the bullish side, because we're 5 to 7 pennies now above that floor. So this would be $60.75, and the total trade would cost you just more than $50, which would be about 50 cents of movement you would need away from $60.75 to get to your break even. And these are noon, so you would have until 12 o'clock, an hour and a half after the news breaks, right?
Yes.
And just to do a full comparison, then we jump to the 230s. And so these line up relatively nice as well. As oil continues to trade, now we're approaching $60.90, and these have a $61 price. Now the difference here is you have $3 of potential as well. So we have $61 up to 64. We have $61 down to 58. You could be buying the bullish spread. And now the bullish spread, completely out of the money. You're going to have intrinsic value on the bearish side because we're 10 pennies, 11 pennies under $61. You'd be buying the bullish one. That would cost you $20. You're getting in at 61.20, the floor being 61. You'd be selling the bearish one. You're going to have intrinsic value there of about 11 pennies, and that would be costing 36. So not a bad trade for the 230.
No, I like it.
For 56,
I like the bearish side of that too, actually.
For $56, and you would have 11 penny head start, call it, to the bearish side. And again, you have till 2:30, and yeah, for the movement we've seen in oil over the last 2-3 weeks, the movement does not stop at 12 o'clock. That's for sure.
No.
Or at least it hasn't. And we'll see how the numbers come out today. What happens after the 10:30 inventory report. But, and again, so $56, that would represent about 56 pennies of movement away from $61 you would need to get to your break even on either side if you took both sides of the trade. But just to put it in perspective as well, you know, you could take either side of this contract, defined risk. On the bearish side, you're starting out with intrinsic value. On the bullish side, it's an out-of-the-money spread. You're starting with just premium, and 61.20 becomes your break even on the bullish, or, you know, wherever you're getting in on the bearish side becomes your break even as well.
Yeah, I think we're going to get some action here, man.
Yeah.
You know,
history in the last 2 or 3 weeks would say so. We would see where it goes. But oil in general, I mean, you have action in the dollar recently, right? Commodities in general, gold's gotten some action. All right, we got 3.5 minutes till the numbers, folks. 10:30 a.m. Eastern Time. We're approaching 10:27 right now. We'll be back in 3 minutes with those oil numbers. Come on back. Welcome back, everybody. Tommy O'Brien with Tom O'Brien. So we got the Dow still negative, S&P's relatively flat, NASDAQ up 6 points, and we have those oil numbers coming in. We got crude oil inventories rising 5.02 million barrels, gasoline inventories falling 6.27 million barrels. And as we jump over, let's take a look at how that is reacting to the market. And we will get over. So quite a spike. I had this chart up. If you take a look, we were just under $61, if you recall, coming into that 10:27 as we ended the last segment. Within 3 to 5 seconds, literally, oil spiked down 40 cents, down to $60.51. Within the span of the next 10 to 15 seconds, it was back up to $60.90. And as we speak, it is now at $61.08. We're 1 minute and 20 seconds into the market, post EIA numbers. And we have some volatility, that's for sure. So we'll see how these numbers react. And again, we had a bunch of different pivot points we could have used, right, with those different trades, depending on where we lined up. The 231 would have been using $61 as kind of your pivot with the floor and the ceiling of the two different spreads. If you're making,
I love that 231.
That's exactly, and that was the one where
if you're looking at this chart, folks, that spike lower was intense.
It was literally, and that's, you know, I don't exaggerate, within 3 to 5 seconds, it was down 40, 50 cents, and within the next 10 to 15 seconds, it was back up to $60.90, right where it was before the news. And you can see it jumping around right now as we speak. And so, yeah, we have the spreads still up here right now. And with oil trading literally within a penny of $61, you have about 25 pennies of premium on both spreads still. Because guess what? I mean, no matter what the news is out, the market's aware that it's still digesting this number, which way it's going to go. And so there's premium, even though there's very little intrinsic value right now in either of these spreads. And that's where, you know, you don't need to wait for expiration. You could trade these out, especially the 230 is going to have premium for the time in there until 230 with 4 hours left until expiration. And you know, you want to have some quick fingers in here if you ever plan on executing maybe one side of the trade out, letting the other side go. You can always have your order in there ahead of time because, man, we saw that spike down to 60.50, and then we saw the spike up to almost 61.20. You're talking about almost 70 cents of movement in the span of about a minute, minute and a half. And as we speak, now we're below $60.80 as it oscillates around.
And, you know, when we take a look at, we have the Bloomberg Live up, and you can see what's happening out here. Is that traders are having basically trying to digest that you got a big build, okay, and then it was offset by drawdowns in gasoline and diesel. And I suspect the market is looking and saying, okay, are those drawdowns that have to do with, you know, the bad weather we've had up in the Northeast? People want to make sure they have enough, you know, gas for their cars, you know, heating oil for the house.
Yes,
you know,
no, and as you, I mean, there are so many numbers that come out within that report in terms of supply, demand, imports, production, and so the top line number is kind of what gets reported first and foremost, right? The crude oil inventories. What were they? What were the expectation? What did they come in at? But like you say, there's so many numbers contained, and it takes everybody a few minutes to digest what that means for the market and how it should get traded or how people expect it should get traded. Because, you know, like as coming over at 10:33, U.S. crude imports were quite weak last week, running 7.6 million barrels a day, down 418,000 barrels a day from the previous week. Canada particularly weak, down 344,000 barrels a day week on week. And Saudi Arabia and Iraq both down too. I mean, country by country breakdown of barrels per a day imports, let alone just the baseline inventory number that comes up there. And let's just jump back and see as we give it a minute. So $60.91 currently. And when we looked at that trade, it was costing us maybe $55 to $60 for the 230 trade. That would represent somewhere in the neighborhood of 55 to 60 pennies that we would need away from $61 in either direction to begin breaking even, and then you have profit potential in $3 on either side of that.
And you know what's intriguing about this, Tommy, right now? You know, we're talking 230. That trade still can be done. This is what's kind of interesting.
Yes,
here, right?
Oh, definitely. And what does happen is a little bit of that premium will come out of what you're paying, right?
Because the news is out, right? Yeah.
Exactly. Now, you know, the 230s in particular, especially as it's trying to digest that news, there's still some premium in there. But yeah, I mean, it's, you know, it's still only 12 pennies away. You're going to have intrinsic value in the bearish spread. You're going to be paying all premium in the bullish spread, and it's still lining up. There's about 20 cents of premium in each. Oh, and as we say that, the market's changing as it spikes a little lower. But you can see that there's intrinsic value in the bearish one because it's below $61, and there's a very similar level of premium as it was near it. Now as it gets 25 pennies away from it, things change slightly. But yes, I mean, that's something for sure, you know, because there is some premium that just got sucked out of there right after the news came out, at least a few minutes afterwards, because there's always the surprise element that it could be drastically away from expectations and could spike real hard in one direction or the other. And it seems like that risk is kind of eliminated at this point, right? But
yes,
the risk
for this hour.
Yes, no, for sure. As we speak, now we're under $60.70, 60, 66, 60, 65. So we'll check back in on it. We'll see how that progresses throughout the hour.
Yeah, this 231 was a beauty, man. That's, you know, because I think the reason I'm saying that is because the last 2 weeks we have had very large moves, you know, and they just take a while to kind of, you know, digest that whole deal. So
no, and so to jump back to my chart real quick, you know, let's say you were bullish or something, as you could always buy back your bearish spread You could get about $43 right now as the market jumps, call it $45. You take that off the table, and let's say you were looking for the market actually to rebound to the positive side. You take the bearish spread off the table, you take a decent chunk of your investment back, cut your losses to maybe only $10 to $15 per trade for both sides, and then your bullish spread remains open if you're expecting that type of inventory report to allow oil to move to the bullish side for the remainder of the day. You have from 61 to 64 until 2:30, and you could always take off one side of that spread, and vice versa. You know, if you were bearish, you get the initial spike to the bullish side. You could always close out the bullish spread, keep your bearish spread open, and same thing. In prior weeks, that type of trading would have been a profitable way to trade it. Doesn't mean it's always going to happen. Things, you know, the trend could just continue. You know, we haven't been hanging under $60 in a while, and it'd be interesting if this kind of sent it, as we're only about 60 pennies now, 59, away from that $60 price point at this mark.
No, there's no doubt.
Yeah.
And, you know, if we look at the trading from yesterday inside that contract, that had big volume on the way down yesterday. That's why I was bearish, basically.
Okay.
You know, if we pull this up, I'll have, now this is a delayed quote, folks, but what does happen is that you will see the volume on that move yesterday, and that volume was pretty intense on that move yesterday. Let me pull this up. So this is showing that it's trading higher than it is, but this is a delayed quote.
Sure.
But if I do it, if I pull this up, what you're going to see is that we had some monster volume as that was pushing into its lower swing yesterday. Look at it sticking out like a sore thumb.
So again, that's your market bias. Everyone has their market bias. You figure that out. You look at the trade setups. You compare the risk reward. All right, we'll see where it's at in 3 minutes when we come back. Come on back, folks. Dow Jones down 54 points. S&P negative by 1. Welcome back, everybody. Tommy O'Brien with Tom O'Brien. We get the Dow down 48 points, S&P's flat, NASDAQ positive by 13 points. And to check back in on the oil contract, we're now at 10:54 a.m. Eastern Time, and we got it trading at about $60.79 currently. And again, the trade.
Laying there now.
What's that?
It's kind of just laying there.
It is, and if you look, what's interesting about the chart is that every bar is kind of creating this triangle so far. And again, we're only 25 minutes into the news. Man, we've seen turnarounds at 11 a.m. We've seen turnarounds at 11:30 a.m. recently, so the trend is not set here for sure. But it is interesting. The first bar, so wide. Second bar, a little bit more narrow. Third bar, right, high or low. Fourth bar, again, and then these last two 5-minute bars we're looking at are very, very narrow in terms of $80, $60.80. So again, you know, to kind of wrap up.
Which way is it going to break?
That's right. If it's going to break, we'll see. We will see. So we'll see where the day plays out. You would have had till 2:30 on that one trade we kept talking about with $61 as your price point. And we'll see where the day leads on crude.